Welcome back to Factful Finance. Have you ever wondered how large institutions and savvy investors handle the wild swings of the market? What if I told you they manage risk using complex financial tools that you can learn about today? Get ready, because in this video, we're diving deep into the fascinating world of swaps and hedging with derivatives. Now, before you get lost in the jargon, let me clarify. We're not talking about a random financial tactic or something only used by Wall Street big shots. We're talking about strategic tools that are designed to protect against the unexpected, like price fluctuations, interest rate shifts, and currency risks. Imagine trying to grow a business only to find yourself hit by unexpected costs or unpredictable markets. That's where swaps and hedging come in. But here's the thing. Using these tools successfully requires more than just understanding how they work. It requires an understanding of the financial principles that underpin them. We're talking about risk management, portfolio diversification, and the very essence of financial economics. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. So what exactly are swaps? To put it simply, swaps are financial agreements where two parties agree to exchange future cash flows based on different financial instruments. The most common types are interest rate swaps and currency swaps. Let's break that down. Take Henry, for instance. He's a US-based company that's borrowed money in euros to expand internationally. Henry's worried that the value of the euro might decline, which would make his debt more expensive when he converts it back to dollars. To hedge against that risk, he enters into a currency swap with another company that has debt in US dollars. In this agreement, Henry will exchange the future euro-based payments for US dollar payments, protecting himself from fluctuating exchange rates. It's like locking in a price for something before the market can surprise you. Next, let's talk about hedging. If swaps are the tool, hedging is the strategy. Hedging is a risk management strategy used to offset potential losses in investments by taking an opposite position in a related asset. Think of it like an insurance policy for your investments. For example, if a commodity producer, like Ava, knows that oil prices are volatile, she might hedge by buying a futures contract that locks in a price for the oil she'll produce in the future. If prices drop, the gain from the futures contract offsets her loss in the oil market. One thing to remember is that swaps and hedging aren't without their costs. These instruments involve complex calculations, legal agreements, and often substantial fees. And, much like insurance, they come with their own risks. If the market doesn't move in the way you expected, you could end up paying more than you would have without the hedge. But in the right circumstances, they can be incredibly effective. Now, I know this all sounds complicated, but let's look at some data to ground our understanding. According to the Bank for International Settlements, the global swap market reached a staggering $500 trillion in outstanding contracts in 2022. That's not small change. It's an indicator of how critical these financial instruments are for managing risk across industries worldwide. But not just any company can take advantage of swaps and hedging. Olivia, for instance, runs a startup in tech. While she may not have the resources to deal in swaps directly, she could use similar principles in her business. For instance, locking in fixed interest rates for loans or hedging against future currency fluctuations could be the key to stabilizing her costs as her company grows. The key takeaway here is that swaps and hedging are essential tools for managing financial risk, and they're used across industries, from global banks to tech startups. They allow businesses to plan for the unknown, reduce volatility, and ultimately protect their bottom line. Before we wrap up, think about this. If you're an investor or business owner, how could you use these principles to manage risk in your own financial portfolio or business strategy? Whether it's through hedging against currency risk or using swaps to stabilize cash flow, the idea is to make your financial future more predictable and less vulnerable to market shifts. So, what's your biggest risk management challenge right now? Drop it in the comments. I'd love to hear from you, and I'll respond to as many as I can. If you found this information valuable, Don't forget to hit that like button and subscribe for more insights into the world of finance. And remember, managing risk with swaps and hedging might seem daunting at first, but with the right strategies, you can build a more secure financial future. If you're ready to take your financial knowledge to the next level, watch the video on screen now. It's a must-see.